Gulam Zia joining us this morning, Senior Executive Director at Knight Frank, to speak more about it. Also joined by Ronald Siyoni, Research Analyst at ICICI Securities. Welcome to both of you, and thank you so much for coming in. Now, Gulam, this is setting up, and very good morning to you. This is setting up to be a bit of an undesirable combination of higher unsold inventory, increasing supply, and prices also increasing while houses are not going at the same rate.
Good morning, Tamanna. Thank you so much for calling me. Always a pleasure to talk to you, Tamanna. The point here is, while the inventories are slightly, going higher, and the sales numbers are not very satisfactory, but we have to also look at the velocity of sales. That's one factor which not many of them have been talking about. The velocities have been pretty much steady. When we are looking at it, the amount or the time required to sell for the selling of the entire inventory in the market even today is not more than 2.5 years, which gives a comfort that bad times are not yet around the corner. So when we are talking these numbers, we have to look at also how quick are these inventories going off the shelf. And that number, of course, it varies from city to city. Like up north, perhaps in NCR, it is actually some worrisome situation arising out of NCR. Even Bangalore is going a little shaky. However, the other markets are nothing to worry about. And that's where net Mumbai also, while we are talking about, the transactions slowing down, but the IGR, which is a registration data month on month, is perhaps going absolutely neck to neck YOY. Even in the month of July, when we're looking at the transactions that we've recorded, it's actually upwards of 12,000 recorded transactions in Mumbai, which was very similar to what it was in July of 2024. So my only point here, Tamanna, is that while numbers are looking a little slowing down, however, we have to look at a couple of more quarters before convincingly saying that the slowdown is here to stay. Otherwise, it could still be just one more blip in the data that we have been observing. Over to you, Tamanna.
Okay, so that's an interesting perspective. Gulam, morning to you. Ronald, I'll come to you on this one. Do you have a slightly different interpretation of the data that you've seen so far? Do you anticipate that the pricing increase that we've seen in the very recent past in certain micro markets has gone a little too far, and perhaps that's going to curtail demand in the near term? Or do you think that festive season demand will once again push things forward?
Yeah, good morning and thank you for having me on the show. So first of all, the listed space, had already conveyed the message that this year, is not going to be like a couple of years past. We have seen a phenomenal growth in pre-sales number. This year, as a high base effect comes up, so it would be around 10 to 15% of the larger players growth in pre-sales. So they have been, looking at the data, and they see that, pricing environment, the prices have increased over the last couple of years and significantly in some regions like NCR. And hence, the pricing outlook is not very, very positive. A single to, lower double-digit kind of pricing outlook is there, while the play would be on volumes. And these companies, companies like DLF, Oberoi, or say Godrej Properties have learned over the past cycle. They have have selected good pockets in a particular regions, and they are getting phenomenal response in even in Q1 of FY26. So we have seen DLF clocking more than 11,000 crore sales in Privana North. We have seen DLF's Mumbai launch, West Park at Andheri, doing phenomenally well. Hence, the overall market, still on the new launches, they have seen a very, very good absorption and at a very quick pace. However, sustenance sales, the projects which were launched much earlier, they are seeing a slower traction, we can say. But these companies, have upcoming launches more towards the H2 of FY26. Right. And hence we should expect good traction in H2 FY26.
But Ronald, Ronald, very quick question. One is to look at FY26 alone, and one is to look at over a 2-year period. Could this actually slow down volume plus value growth combined over a 2-year period, also considering the fact that the base is high, and will the market discount it earlier?
So market, I think, has already discounted it, and I think this is the fourth or fifth year of the upcycle, and hence, the base would catch up, and it is going to catch up. There's no doubt about it. But here one thing is to be noticed is that even is, despite the base getting catch up, such a high precise trajectory, if they are able to maintain for a longer period of time, say 2 to 3 years, it is much more positive, compared to the last reality cycle. And if you see the RERA cash, which would be available for these companies over the next 4 to 5 years, considering the strong launches and precise booking they have been doing over the past 2 to 3 years, that provides a lot of growth avenues, stronger balance sheet for these companies, and hence I think they shouldn't be worried about if somewhere down the line if sales in the residential starts tapering off, because they have also
Who
started
is
to invest in
Ronald?
commercial
Who is?
assets.
Which are the companies that are most shock-proof right now, if there is a downtrend? Gulam Zia said bad times are not around the corner yet, but there seems to be smoke signals that you can see. Who is the most resilient? What is the
So I think
stock-specific play right now in this space?
so, we are looking at much stronger companies with having a quality balance sheets like DLF,
Okay.
Oberoi Realty,
Okay.
then, Max Estates in smaller mid-cap space. Then we have Aditya Birla Real Estate. So this all Arvind Smart Spaces. So these all companies, have much more sturdier balance sheet and can ride through the tough times, even if it's 2 to 3 years down the line. And they have future proofing their earnings with improving their commercial assets. They are investing in commercial assets. We are seeing a lot of interest from GCC countries. So they are providing they are looking at getting a continuous annuity stream or income from these commercial assets, which should ride during the tough times. So they have become a lot smarter, compared to the previous cycle which we have seen.
Okay, so even if it's 2, 3 years down the line, I don't know if it's 2, 3 years down the line, but stick with the ones with a steady balance sheet. Thank you so much, Gulam and Ronald, for speaking with us this morning.